Prepaid expenses are expenses that you pay in advance for future use. So, whenever you pay something in advance for future use, that means that you have the right to use what you paid for in advance in the future. So, since you have the right to use whatever it is that you made an advance payment for, then that is considered a prepaid expense. Prepaid expense is classified as an asset because that initial payment, that advance payment, is indeed an asset because you've paid already for something that you're going to use in the future. So, common prepaid expenses you see here on the screen are rent, insurance, supplies, and depreciation. So, whenever you make a payment to rent, those of you that rent, places, and you make that payment at the first of the month, well, to the company, that first of the month payment, technically, they shouldn't report that as revenue yet because they haven't earned it yet because you made an advance payment for the month of, let's just say, January. Okay, so if you made a payment on January 1st and it's for the month of January, you have the right to use the facility for that whole month. Okay, so the initial payment is going to be classified as a prepaid expense, an asset. All right, so that's an example. Insurance is pretty much like rent, where you make an advance payment for insurance policy for coverage for 12 months, 24 months, etc. That's you making a prepayment on something that you're going to use up in the future, and you've paid it off already. So you have the right to use it. So that's a form of prepayment. Then you have supplies. Supplies is another form of prepaid expense. That's when you go in and you buy supplies. Supplies is initially recognized as an asset. Once you use it up, then it can be expensed over time. So that is a form of a prepayment there. Then depreciation. Depreciation is a little unique. I'll put a little asterisk there. It's a little unique compared to the other prepaid expenses here. So I'll go over that here in a bit. Now, what I want to talk about is prepaid rent. How does that work? How does a company report this in their books? Now, we're going to assume that the accrual accounting method is used from here on out. Okay? So, when it comes to recognizing revenue and recognizing expense, accrual account is going to be used. So, prepaid rent. So, the example I have here is Bob. There we go. Make sure everything's on the screen. Bob paid in advance of $6,000 to rent a facility for 6 months. The payment was made on January 1st. So payment made on January 1st. Okay. So Bob made an advance payment for $6,000 to rent out a facility for 6 months. Right. So initially what Bob would need to do, as you can see here, on January 1st, Bob is going to first credit cash for $6,000 because cash did go out no matter what. So that's going to reduce the balance in the cash account when you credit it. Then prepay rent. This was what the payments was for. It was for rent, prepaid rent, to rent out a facility for 6 months in the future. Okay, so this prepaid rent account is going to be debited for $6,000, and that's going to increase the balance in that account. And yes, prepaid rent is an asset. Okay, that's what that initial payment was for. So Bob has the right to use the facility for 6 months since the cash payment was already made. Okay, once the first month has been used up, then Bob is then going to now reduce the prepaid rent account, the asset account, by $1,000, and he's going to move that balance into the rent expense account. So he's going to be expensing the advance payment he made on January 1st on a monthly basis. Now, how did I get this $1,000? Should have done that before. I went over this entry here. I took $1,000, divided it by 6 months, which gives me $1,000 a month. Okay, that's how much is going to be expensed at the end of each month up until the very last period, very last month. Okay, so in February 28th. So this is the second month. Same entry is being recorded. So the rent expenses debited, that's going to increase the balance in that account. Prepaid rent account is going to be credited. So you're just moving that balance on a monthly basis from the asset account into the expense account. Okay. Then we go over to insurance. Okay, insurance. So insurance, if I can get everything on the screen, is just like rent. Making an advance payment for insurance coverage. So in this example here, Bob paid in advance for insurance coverage for 6 months for $12,000. Payment was made on January 1st. Okay. Scroll up here or scroll down here, same thing. On January 1st, cash is going to go out no matter what. So cash is going to be credited for $12,000. So that's going to decrease the balance in that account. What was it for? It was for a prepayment of insurance coverage for 6 months, which means that this $12,000 is going to be debited to prepaid insurance. You have the right, or Bob has the right, to be covered for insurance for 6 months due to the payment. Once the first month of insurance coverage has expired, prepaid insurance is going to be credited for $2,000, and it's going to be this $2,000 is just pretty much going to move over to the insurance expense account for that same amount, increasing the balance in that account, because you're slowly expensing the insurance coverage that you already paid. You just used it up for the whole month, okay? Because the time has expired. So how did I get that $2,000? Take $12,000 divided by 6 months. Okay, that gives me $2,000. Okay, I know I'm doing this kind of backwards, but bear with me. Hopefully you understand what's going on here. Because if not, I did not do my job. Okay, so now we go to February 28th. February 28th, we see the same exact entry as the January 31st one. So insurance expense is debited for $2,000. That's increasing the balance in that account. Prepaid insurance is credited for $2,000. That's decreasing the balance in that account. All you're doing is moving that balance from the asset account into the expense account, slowly but surely. Okay? That's prepaid insurance. Now we go to supplies. Okay? Supplies. So supplies is somewhat different than prepaid rent and prepaid insurance. So the concept is still, or the method is still the same, but it is slightly different as far as how to expense supplies. So it's not like prepaid rent and prepaid insurance where they give you a dollar amount of what was paid, and then for how many months, how many periods that amount is covering for. It's not like that with supplies. Prepaid rent and prepaid insurance, it's like that. So it's easy to figure out the amount that needs to be expensed on a monthly basis. But supplies, that's not the case. Supplies, they're going to have to pretty much tell you, okay, out of what was purchased, this is how much that was used up, or this is how much that was still on account. Okay, so that's the difference. So given this example here, Bob bought office supplies for $5,000 on January 1st. That's what we see here, January 1st. At the end of January, Bob has supplies of $2,000 still in hand. Okay, so pretty much he has supplies of $2,000 still on account. Oops, did I erase that? Still on hand. I don't know what happened to that O there. So first thing we're going to do is recognize the acquisition of office supplies on January 1st. Okay, so January 1st, we're going to credit cash for $5,000. That's going to be a decrease in the balance in that account because cash did go out. Bob bought office supplies. And then what was it for? Yes, it was for office supplies. So the office supplies account, it is an asset account, and it's going to be increased. Okay, so supplies, office supplies, it does have somewhat value, so that's why it's an asset. So there's kind of some little bit of controversy there when it comes to determining whether office supplies should be just expensed as soon as the cash goes out, or should it be an asset. So it is an asset, Some companies probably just go ahead and expense it right away. But it is an asset because, I mean, technically it has value. It may be very little, paper clips and pencils and pens and stuff, paper. It has some value, but it is an asset. Okay, so on January 31st, at the end of the period, well, first, let me go back up here. It says at the end of January, Bob had supplies of $2,000 still on hand. In other words, still in its account. This means that $2,000 here should be shown as the ending balance in the office supplies account here, the asset account here. So this means that I'm going to take $5,000, which was debited into this office supplies account, and I'm going to subtract out this amount here, 2,000, which is what should be shown in the office supplies account. And so this gives me $3,000. This $3,000 is the amount that was actually used up during the period of January. So to recognize this usage, we're going to credit office supplies for $3,000. That's going to decrease the balance in that account. And we're going to move this $3,000 into the office supplies expense account. That's going to increase the balance in that account. Okay. So $3,000 was used up. So now if we take 5,000 from here, office supplies, the asset account, subtracted from this 3,000 here, we actually get $2,000. This matches what they tell us in the scenario here, that's what Bob still has in his account. Great. All right, last prepaid expense. I know this video is a little long. Okay, depreciation. So depreciation expense. So depreciation is pretty much the wear and tear. It's a wear and tear on of long-term physical asset like a vehicle, machinery, equipment, building. There's wear and tear on these things. So as soon as you initially buy it, it's going to have its wear and tear once you use it. So for example, a car that you get at the dealership. Let's just say you get it brand new. And once you get it brand new, you drive off the lot with that car. So once you do that, that car is now depreciating. So with cars, you measure the depreciation usually by its mileage, because the more miles it has on a car, the more depreciation that it is on put on that car. In other words, the more wear and tear that is on that car. So that's what depreciation is. And with the depreciation, you have to recognize that as an expense in the books. Now, you did buy the asset. So when you bought the asset, that's a cost. Now, the whole question is, how do you account for that cost? And so you account for that cost by, the usage of it, and then figuring out, based on the usage, the costs, and whatever else that you need to know, how much of depreciation that needs to be recorded. All right. So what you see here on the screen here is like an example that I put together. This is going to be an example of an equipment here. Okay. We're pretty much an equipment, whatever it is. Okay. So we're going to say the cost of the equipment was $50,000. Useful life is 10 years. So that means that you have this equipment and you're planning on using it for 10 years in your operation. Then the salvage value that you believe that you can, whatever amount that you can get from the equipment once it's used up after the 10 years or after 10 year mark, $5,000. Here's the salvage value. So this is when you actually believe, okay, after using it for 10 years, this is how much it's worth. So when it comes to depreciation expense, it is calculated first on the yearly basis before you get to the monthly basis, or you can just jump straight into the monthly basis. But when it comes to the methods that are given, it's usually calculated based on a yearly basis. So depreciation here, the common method that is used to record depreciation or calculate it, is the straight line method here. Straight line method is pretty simple. You're going to take the cost of the asset, subtract out the salvage value. That's how much you believe it's worth after it's used up. and then you divide it by useful life. So that's going to give you your depreciation a year. So given the scenario here, or the points we have here, $50,000 is the cost, useful life is 10 years, salvage value is 5,000. We're going to put these amounts in this equation here, straight line method equation. So you got 50,000 minus 5,000 divided by 10 years. Again, 50,000 is the cost, 5,000 salvage years. Sorry, salvage years. What am I thinking? I'm jumping ahead of myself. Salvage value, and then 10 years, it's the useful life. Okay, that comes out to be $4,500 a year. Now, businesses have income statements or P&L statements that they actually prepare on a monthly basis to evaluate how the company's performing. So since depreciation expense, it is an expense, that's going to be shown in the income statement. So you need to now break this down, $4,500 down on a monthly basis. So on a monthly basis, we get $4,500 divided by 12 months. That's $375 a month. So this is the amount that needs to be recorded as depreciation expense on a monthly basis for 10 years straight. And that's if it doesn't change. Useful life can change depending on the operation of the equipment, but that's a whole nother thing. Okay, so we record this in the books at the end of January. So we're going to say the first month, the machine was used up for the first month. It did its thing. It produced items for you to later sell. The account that's going to be debited, no stranger here to this, is going to be an expense account, depreciation expense, and that's going to be debited for $375. That's going to increase the balance in that account. And the account that's credited, it's not equipment. Okay, it's not equipment. Okay, instead it's an account called accumulated depreciation. This is a contra asset account that is connected to the main asset account, which is the equipment account. So it is connected, and that's going to increase the balance in that account, this accumulated depreciation, because again, it serves as a contra asset. Now, one thing about contra asset before I leave is the contra asset account is going to have an opposite normal balance than the main account. For example, equipment is an asset and it has a normal debit balance. Okay. Accumulated, I'm going to abbreviate this, accumulated depreciation account is a contra, there we go, asset account that has a normal credit balance. Okay, because this credit balance is supposed to go against this debit balance. In other words, it's going to reduce the balance in the main account. Okay, so this is what this account, accumulated depreciation, is for.